Hello, hello, hello. Good afternoon, everybody. Thank you for joining today. I'm Carlos Garcia, and joining me is Nick. This is our part three of our three-part credit education webinar series. Super excited for those of you who've joined all three live, and we have a really awesome program for you today. And the topic is helping clients get access to capital. I'll talk for those of you who are joining for the first time and you might not know who I am or who Nick is. We'll do a quick little introduction. So, this is something that Nick and I put together because we both have a strong passion for not just how to have conversations with clients and become better guides as they are going through different stages of their financial life. And Nick is, he'll tell you a little bit about himself, and I'll tell you a little bit about myself. But essentially, the goal of this series is to help us become better equipped as financial advisors, as business advisors to our clients, beyond the traditional services that an accountant, bookkeeper, and tax preparer provides, which is just really a compliance or just getting their numbers accurate. So, like, how can we have further conversations so that we can help them achieve their financial goals and help them become financially successful? And so I'll turn it to Nick so he can do a quick little intro, and then he'll bring it back to me.
Yeah. Thanks, Carlos. Excited to be here with you. Obviously, this all was sparked from us just being together and talking about things that we're passionate about. And for those of you who know me, if you've been on the series, my name's Nick Boscia. I have an accounting firm in New Jersey, Boscia and Boscia. I run it with my brother. And on top of that, I'm also known as the Balance CPA. And what I'm like really passionate about is just learning as much as I can and taking the knowledge that I've learned and sharing it with other people to improve their life, help them achieve their goals. And what we're going to get into today is talking about how we could better advise our clients. And once me and Carlos kind of connected, we both are super passionate about helping other people. We figured why not get together, collaborate, and share what we know with hopefully to help you today.
Right on. Thank you, Nick. And you guys make sure you scan the QR code if you haven't connected with him on LinkedIn. Get to know his content because he's got tons of great insights and experience, and really awesome to follow your journey, Nick, on like how you've been able to transform your firm from being like old school to using technology and then also incorporating like work-life balance. And I know that you're now on the journey to offering and expanding advisory services. So this is like super awesome to be connected to you and see that you actually transforming your firm as well. So that's really cool. So a
Thanks.
little bit about me. Yeah. So I'm a sales coach, speaker, and I'm founder of Exceed Sales. I'm also the co-founder of Reframe. For many of you who know Hector Garcia, he's a CPA, accounting influencer on YouTube, and he and I started this community about 4 years ago. And we have an online community. We teach accountants, tax professionals, and bookkeepers how to be more forward-looking. And so we teach these kind of concepts, like how do you position advisory services and create more value, so not just so you could charge more for the value you create, but also help your clients transform their business and achieve their financial success. I do come from a banking background and leadership background and commercial lending, so today's topic is near and dear to my heart because it's something that I've practiced in my profession for a very, very long time. These are things that I used to teach bankers so that they can become good at their world. And if you want to connect with me, if we're not connected yet, feel free to scan that QR code and happy to say hello. So let's talk about today's conversation, which is first is understand like why people usually have a need to borrow. And in a lot of scenarios, you're going to have clients that fall into different categories inside of their business's life cycle. We're going to talk a lot about business life cycles and stages that businesses fall into. Okay. If you are the kind of professional that serves clients that are just kind of starting up and getting their feet wet, or they're trying to figure out where they are in the marketplace, and you might run into clients who are starting to scale. They landed a few really big clients and now they're they have to staff up, or they need resources, they need more equipment, they need access to tools and ways to better serve the clients because basically they're running out of capacity, and if they don't, they lose the client. And so a lot of these scenarios prompt business owners to need access to capital so that they can grow and expand and scale accordingly. Um, we're going to talk a little bit about when capital is needed across of those stages in the life cycle, and then when it's needed beyond just like asking for like someone to invest equity into the company. That's one way you can get capital. You can borrow personally. That's one way to get capital. It's probably not the way we recommend it. But you can also borrow commercially, and you can teach clients how to build business credit and how to build a reputation so that when they go to a banking partner, wherever their primary bank is or whatever commercial lender is out there, they can set themselves up for success. And what I like to call is make them credit ready, right? Like, so when that moment happens, they're ready to borrow, like they qualify, they can get the loan that they need, they can get it in the terms that are favorable because, like, a lot of people sometimes tend to just react. They're like, oh my God, this just happened. I just landed this huge account. And it's like, now I need 100K to be able to buy this equipment so that I can service this client. And a lot of it is reactive. And when that happens, in most cases, the client wasn't financially ready to show up in the bank and become like ready to get approved for a loan. And that we got to see a lot in the banks. Like on average, business credit loans and line requests, our approval rates used to be anywhere between 20 to 30%. And that 70% of people that didn't qualify is typically because they just didn't have their ducks in a row. They didn't have their finances ready. They didn't have their credit ready. They didn't know. They didn't have enough experience with the bank. So we'll talk a little bit about this concept called the five C's of credit, which is what those are five elements that a lender looks for to see if the borrower is ready to borrow or low risk, and then provide the borrower with favorable terms. Then we'll talk about what the purpose of like why you need the loan matters in terms of what kind of loans and credit terms are available, and all of those things affect like a monthly payment, what kind of interest rate you'll get, and what other terms show up for the loan, and again the risk that the lender takes if they are to approve you for a loan like this. We'll talk a little bit about the SBA, which is an awesome program provided by, the government basically to help a lot of business owners grow, expand, and they have a lot more favorable terms for people who are expanding and growing, looking to acquire a business. And there's a lot of options that you can also share with your clients to explore that. And then I'll share with you a tool that you could use for your clients or for yourself when you're getting ready for an advisory conversation, and capital needs is one of those topics. And you can do this with your clients so that you could prepare them to be credit ready. And then we'll talk a little about the advisor's corner in the sense of like, what are some good questions you can ask proactively so that you can help your clients prepare when they're looking to transition from a specific stage in their business life cycle to the next stage, right? If they are currently in growth and they want to go to expand mode, or they're in expansion mode and they're ready to step into a maturity, there's different needs, different strategic decisions that they'll need to make to be able to move into that stage effectively. So that's a little bit about today. And Nick's going to launch a poll to get us started, which is when a client needs capital, where do you usually start the conversation? So you'll see a pop-up show up, and it'll ask you this question, and a few answers for you to consider is maybe you start by asking what the money's actually for. Maybe it's pull up their cash. You immediately go to the reports. Maybe you point them to a lender and say, "Hey, that's not my problem. Just talk to this person." Or I don't know. Maybe you want to just wipe your hands clean and say, "I don't want to attach myself to this," because maybe you've been burnt by a lender before. Who knows? Like there's so many reasons. Especially when I used to be a banker, accountants used to not love talking to bankers. One, because bankers would bother them through tax season and they're like, "Go away, I'm busy." And two, it's a lot of accountants, bookkeepers, they feel a little bit like, well, if I recommend you and you drop the ball, then it goes back to my reputation. And so there's a few different things. Again, just me showing you the lens of what a banker that maybe solicits you to be a partner to them, a referring partner. But like you could also ask, look at what cost the cash gap, or you could ask whether they can even afford the payment. I mean, some of you go that deep, and that's okay. So I know that we've got the questions. We're going to close it soon. So if you haven't answered it, make sure you answer the poll. But Nick, I'll turn it to you real quick as you look at this question. What feels true to you here?
Yeah, for me, I would say number one, I would ask what the money's for. If a client's coming to me, I would want to know, hey, what do they need the capital for? Are they growing their business? Are they maybe not operating properly and they're, operating at a loss, and just kind of identifying what the root cause is, because then that could lead me into where I would take the advisory services. And I wanted to call out Deb's comment in the comments, which I thought was funny, is that's unfortunate. We have serve a lot of clients, and we typically find out when they borrow money. We just see a deposit, and when we're doing their bookkeeping, we see a large deposit, like, oh, I took a loan from this or that, and that's typically how we find out. So I was excited for today to actually figure out ways where I could proactively reach out to my clients
Mhm.
and assist them rather than just go find capital on their own.
Yeah. Or even if it's like, I would think about for those of you who are either doing the bookkeeping yourself and you're categorizing, or you've got a junior bookkeeper doing that. And it's like, could it even be possible that providing cues of things to look for in the feed, like mining for conversational, we'll call it conversational gold, right? So let's say if you find, like, I know that immediately if I were to see in a bank feed someone had a cash advance from a credit card, cringe, right? Immediately I would go to like, oh my God, what did they do this? Why did they do this, right? Because immediately what goes to your brain, Nick, if you see a cash advance going into their bank feed?
Yeah, I know they're paying high interest rates, and that's not
Yeah,
good.
they're going to pay a 29%, interest rate. There's a fee involved. It came from a personal credit card, like so many red flags, right? And that may not be like a bad habit. It might just be unaware. It could be. I would like to think that many business owners should know that that's not what you should do. But could it be possible that if we overlook that, maybe we're doing the client a disservice by not addressing it? Like, hey, I noticed this happened. Help me understand, what you're looking to accomplish with this. Could it be possible that there are other, avenues you can pursue that will cost you less, that will not have such a negative expense for you on that end? So, absolutely. Great. So we've got some mixed results, and I think everyone's a little bit across the board. We'll share the results so you all kind of see where everybody's at. But the majority taking, dominance here is the first one, right? Is first be curious, ask what the money's actually for. So that's quite interesting. And for those of you who are doing the other things, there's no right or wrong way. Just I would even say like maybe even more than one of these things would be helpful if you really want to step into the advisory role. Is maybe a little bit of all of these practices is are the things that are going to put you in a position to better provide, value-added advisory to your clients. So let's talk a little bit about purpose. We talked about like going back to what many of you answered, right? It's like, what do they need and like why do they need it? And if I were a banker today, then any of you came to me and say, Carlos, I need a business loan. Carlos, I need a business line of credit. And if it's that broad, typically that's how a business owner goes into the bank and say, hey, I'd like to apply for a business loan, or I'd like to apply for a business line of credit. The first question that every trained banker gets asked, because it's the first question that comes into every credit application, is what are you going to use it for? What is the purpose of the loan? And whatever the answer is going to be, then helps us kind of go down the path of, okay, great. Before I solve, it's the same concept of, hey, I need to clean up my books. And then you start asking the questions like, what happened? Why did it happen? And how many transactions do you have? And how many banks? It's the same concept. We start asking deeper questions. But essentially, learning the purpose, it will point us to understanding how are they going to pay it back. Learning the purpose of the loan will help define how much they need and in which time frame do they want to pay it back. It also narrows down what kind of financing we'll be able to offer, what options we can offer. And then understand that like a particular type of purpose, there's certain loans and lines that it's appropriate for, and there's certain loans and lines that's inappropriate for. If someone was to say, I need a line of credit to buy a truck, that doesn't match because lines of credit are typically used for short-term needs. They're revolving lines of credit, which it doesn't have a fixed payment term. And so typically when you are putting a fixed payment or a fixed asset or something that is better fit for a term kind of loan used for a line of credit, that will immediately disqualify. Like the lender will decline it and say wrong purpose. So helping the client understand what kind of loan they need to apply for. So if they said, in the last session we talked about debt consolidation, but if someone says I need to buy equipment, I need to buy a truck, if there's a way if that we could use collateral, then we may have a product, a bank may have a product available to offer even better rates and better terms. Sometimes a business term loan can go as far as 5 years, where if you do an equipment loan, you can go as far as 7, 8, or even 10 years, so, which make the monthly payment lower. Using collateral and being able to place a lien on, let's say, a piece of equipment, could also give the bank, they know that the business owner has skin in the game. They have something to lose, which lowers the risk for the bank. And then it allows the bank to offer better rates and better, more flexibility on term. So purpose is huge. Just one thing that is important, like understanding what are you going to use the money for is huge. Now, some people say, I need it for working capital. And so, Nick, have you heard that phrase before where someone goes, I need working capital?
Yeah, we have clients, especially during we before we were talking about it, during COVID, we had clients looking like just looking to get as much money as possible because there was a lot of uncertainty of what was going on. So we were just getting loans just to have a cushion. So because they didn't really know what was going to happen with their businesses and obviously things now hindsight's 2020, but a lot of our clients were happy to have that money just to cover any unforeseen expenses or reduce revenues and things like that.
So for my finance friends that are here on the call live, I'd love to play a little game. Type in the chat, what does working capital mean to you? If someone says to you, hey, right now I'm going through a cash flow crunch and I need working capital, what would that mean to you? Like if we were to put that into tangible, real definitions of examples of like what does working capital mean? So go ahead and type in the chat. The reason why I'm playing this game, Nick, is when I was really young, I was in the bank and I'd heard that phrase. I was so intimidated by it because I was like 20 something year old and people would be like working capital, just using it like, oh yeah, sure, everybody should know what that means, right? And for some people it means one thing, and for others it means something else, right? And so again, we got liquidity, like spendable cash. Sure. And then if we go a layer deeper, what is that cash to spend on what, right? And typically what it is, it's what ends up happening. We talked about it last session is when your AR, your accounts receivable, is creeping up on you and your clients haven't paid you and your bills are coming up and you don't have that accounts receivable, you haven't collected it yet, but your rent is due, your payroll is due, your taxes are due, there's a cash flow gap. So essentially, a business line of credit, which is typically the right type of facility for this, is the best solution for business owners who maybe have pockets in their business throughout the year. We all know it, right? Like seasonality kicks in. Summer's a little bit slower than normal, or this particular client's business, that's a vendor, right? Like a client of ours is their business is slow, therefore their AR goes from 30 days to 90 days. And in that 60-day gap, there's a cash flow crunch. So typically like a business line of credit helps you fill that gap so that you can meet payroll, so that your employees don't get interrupted, so that you can continue to fulfill whatever orders you need to make to buy the things that you need to pay for the rent to do the so you could still serve other clients. And so that's essentially what working capital tends to be. It's just the gap in cash flow that's happening between your what's called your cash conversion cycle. And so that's a purpose that happens very often. And there might be clients in several industries that do suffer from either seasonality or they might have spikes. Seasonality could be a good thing, it could be a bad thing, right? They have spikes of revenue, so they need more access to capital so that they can hire seasonal employees or they can buy more inventory or they, temporarily. Like I think about Christmas. Christmas is a seasonal business. If you have a Christmas store, right? You're probably going to need a lot of capital during the holiday season because there's going to be a lot more inventory, a lot more traffic, a lot more advertising, a lot X, Y, Z. If you think about Halloween store, like those are seasonality. If you think about tax season is a seasonal business. We know that your most busy times of the year are April and September, October, right? So during that time, you tend to staff up more, you get more emails, you're going to use your software a lot more. So like that's time where you might need access to a little bit more capital and more spend so that you can keep the lights running and not interrupt the client experience. Nick, for you, and anything that comes to mind as we talk about, working capital, seasonality,
Yeah.
customers that you help.
Yeah, I mean, you hit it nail on the head. We're like a big like primarily a tax firm. We also do bookkeeping, but tax season where we collect the majority of our revenue. So we send that from January through April, we collect, I would say, well over 50% of our annual revenue in 3 months. So we have a huge spike, and then we, kind of dwindle down our accounts as we get towards tax season. So now we don't have a lot of activity. We're just doing, just our bookkeeping. A lot of our clients prepay as well. So we got paid maybe back in January through April, even if we're still working on extensions now. So we're working on clients that prepaid us, but the cash flow is not coming in now. So a lot of planning does come into the picture. In the beginning years, it was really hard to manage, but now after a lot of tax seasons, now we're much better at managing our cash flow.
Yeah. And just like the way you run your business, Nick, where like when is the time of year where you could spend time to do team building with the employees, recap, build your processes. Like many of us who are in the tax bookkeeping, like we use summer as the opportunity to go to conferences and network and build new ideas and start rethinking our processes. Like there are businesses that work like that. Now I would challenge those of you who are listening to this is if you're running your business that way, how could you use that inner knowledge of how you run your business to ask your clients questions about how they run theirs, right? It's like when does seasonality happen for you? And when that happens, how does your cash flow uh, get affected? And if you could be proactive in this, and the good news is because you have access to their financials and their P&L and balance sheet, and you can pull some really solid reporting, you could then just start the conversation is, hey, I've noticed these trends are happening year over year. Like Q1 of every year, your sales dip 25%. Help me understand why that is. Some of you know that innately because you talk to your clients. Some of you might not, but like, could you start the conversation with that and say, hey, if we can talk about strategies to like think what we could do during that time to first help you stay afloat, or second, we make up that gap with a different strategy. Would that be helpful? Great. That's your opportunity to bridge compliance to advisory, right? It's pointing out the trends that you see and then thinking about, and then could borrowing be a vehicle to help them, execute that strategy? Could taking a little bit of capital out so they can invest in marketing or something else achieve that? So I talked about this idea of the 7 stages of a business life cycle. And some folks, everyone starts at seed, right? The seed is just the idea, like, oh, one day I want to start a business, or I want to go on my own, right? Like just like many of us, probably one day we may have inherited this from a legacy firm. We may have worked for a big four and say, I'm just going to go on my own. There are different avenues where this starts. And then the startup is like now you're forming the entity, you have a brand, you've got the website, you start doing the advertising. And typically between the stage one and stage two, there's a lot of like building. Like you haven't quite generated, your client base and your consistent revenue streams and your marketing channels and the activities. You're just in the formation piece, especially if you're going in fresh or if your clients are too. But as we think about all these next stages like growth, established, expansion, maturity, and then the last one being exiting, those tend to play a bigger role in needs for cap access to capital because as people scale and sometimes their current capacity goes beyond what they can do, they need additional resources to help them, and money is one of the most valuable sources of resource to help them achieve that. So what I want to share with you next is to think about these 7 cycles, and we're going to kind of look at this uh, by column. So we'll start with the column on the left, which are the same 7 stages that we talked about in this life cycle. And we're going to go from the seed stage down to the exit from top to bottom on the left. And then what we're going to see next to that is a column that gives us what's going on ideally through the small business owner's mind as far as what my top strategic priorities are so that I can execute at this stage effectively and help me transition to the next stage. So we think about seed, right? Which validate the concept, define the business model, secure startup funding, which could be self-funded. It could be find a partner, get an equity partner, get a startup loan. That's possible, right? And we go to the right and we say, what's the capital need? Well, once we validated the concept, then we go into this. What are my startup costs going to be? Well, I'm gonna have to probably pay a graphic designer to do my logo, or maybe I'll build something on using AI, or I got to build a website. I got to register a domain name. Like you start thinking about, all right, what my startup costs are going to be. I'm going to start advertising. I'm going to start creating content. I need to buy a camera to then record. I need to get a video editor, whatever that looks like. It could be other things like that. And then if we look at the financing that fits, again, it could be the owner is self-financing. It could be, I'm not saying this is the right path, but if it's for short-term things, a business credit card could be a small start to use. And then there's this channel called the SBA microloan. And there are micro lenders out there. Has anybody here work with a small business development center or a micro lender? It's called an SBDC. Nick, I'll ask you, I'm curious, have you ever heard of those or worked with any of those folks?
I haven't actually, no.
Yeah. So small business development centers, and I'll actually share the link on the chat, is actually it's directly given from the SBA. So it's this is basically a community development program that typically gets funded by a nonprofit, and their funding is to help enable aspiring startups, micro businesses who are looking for capital. And whenever some of these folks who are kind of in the seed or startup stage are unable to qualify for lending through a traditional lender, maybe because they haven't been established long enough, or maybe they just don't have enough cash flow. Some of these folks can, number one, mentor small business owners to learn how to build a business plan, how to validate their business model, how to think about their target client, how to do advertising. And if they usually complete a program, they will get a grant or they can get access to financing. So that's a really nice call to action I would give all of you. For those of you who, especially in this trade, we want to help everybody. I know that. I get it. Like I think everybody here has a noble heart. We want to help everybody, but if they can't afford you, right? It's like we got to learn how to give them resources that make sense, right? You have a minimum level of engagement, but you want to help everybody. And if you are struggling to grow or to target clients that will afford you and will pay you what you're worth based on your experience, you don't have to say no to these smaller business owners by just saying, no, I don't help you. You could say, hey, that's great. I know you can't afford this right now. Here are a couple of resources you can go to. And there's another resource called SCORE. And I know SCORE stands for something. I don't have it at the top of my head, but essentially it is a small business coaching network that has volunteer mentors that help small business owners learn how to launch a business plan, how to manage, how to grow, how to use resources so that they can successfully embark on entrepreneurship without failing. Because we know there's a lot of statistics out there that like in the first year, a big percentage of business owners that start a business usually fail, right? Or don't last beyond a year. So these are local resources we can provide to the startup, seed and startup. But as you go down all of these other stages, which I'd probably think, if I were a guessing person, this is not a poll question, but type in the chat for me, clients that you help, and Nick, you feel free to respond live. Where do you see your clients most in all of these seven? Reading what you're reading here, right? Like strategic priorities, typical capital needs that they kind of come to you. Go ahead and share in the chat. There's a few of you out there who are joining us live. So type in the chat for the clients that you help, what stage do they fall into? Great. So we
Yeah,
have some that are saying established expansion. What do you got, Nick?
yeah, for me, I would say the most are in two in startup. I feel like that's where a firm specializes. I think a lot of people when they're first starting their business is usually when they're coming to us and they need that initial capital. They have no revenues and things like that. So that's where we help the most. But when, like, I'm curious, your thoughts on like when it gets more into the, established, now they're trying to buy a new building, and I feel like a
Mhm.
lot of guidance has to go into those decisions because they're not just getting off the ground at that point.
That's exactly right. And again, it's I love helping people. Like to me, one of my favorite things in the world is helping someone that has like a ton of like aspirations, right, to build a business. And like from the beginning, I feel like a kid in a candy store. I'm like, "Oh, let me show you this and let me show you that." Um, but it's also equally fun to be able to take on projects where you've got a client who's like, they surpass seven figures and they're now in this $1 million dilemma. They're like, all right, we hit a million and we've got over 10 employees now. And, we're paying 20K a month in rent, which is 240K a year in rent. And like, should I rent or own? I'm like, hey, that's a great puzzle for us to look at together. And then you can go, pull up a amortization calculator and look at, how much money are you, sending nowhere by renting. And if you did this for 10 years, you're spending over $2 million dollars in money that doesn't come back, doesn't build equity for you. Or in 10 years, if you were to buy a property and you finance it this way and you pay it down this much, this is how much equity you build. And then you can use that equity to take out a line of credit, or you could sublease part of that and you can actually generate income off the property. Like now you start getting into strategic conversations of what if, right? One of my favorite things to do, Nick, is like to help preface any conversation so that there's very little resistance. Is I like to start every conversation with dream with me a little bit, right? And it's like it puts people in a space of feeling like what's possible rather than talking about, well, when I'm not there yet, or, I just have to take this out of the way. I'm like, we'll take care of that. But like let's think bigger. Let's think longer term because many folks are just always thinking about like what's in front of them. And we know that the difference between someone who can get from stage two to stage six and seven eventually are typically people who have a great strategy, are great partners by their side, giving them good advice and great vision. And then ultimately just like execution and accountability on that vision. And I think that's where we play a great role. Uh, but to your point, this is where for you, someone like you, Nick, or for those of you who answered, some of them are in two and three, some of them are four and five. The question I'd ask you all is what role could you play to be part of that transformation, right? Like just imagine if you could have someone who you can think of right now that's maybe in the growth stage and you want to get them to expansion, like what role could you play to help them transition to that, right? Get someone who's in a million a year to 10 million a year. Like that's a pretty cool role to be in is by their side, co-piloting with them as they are carefully and responsibly investing and strategically looking at their money to make sure that it all the decisions being made are the right ones. So something for everybody to think about. And then when you go to the right column, the bucket, this is typically where they fall into in terms of like products, right? Banking products and banking vehicles, whatever we want to call them. These are the facilities that they would typically enter into, and then where they would qualify to, because many business owner banks and lenders, they're looking for, by the way, just rule of thumb for everybody, okay? And you probably know this already. And Nick, I'll ask you just pop quiz, and it's okay if you don't know the answer, but how many years of tax returns does a bank or a lender usually ask for a business owner before like when they apply for any kind of business lending other than a business credit card?
I think 3 years.
Yeah, so it could be anywhere between 2 to 3 years. Typically, if we're talking about like bigger ticket items, anything above $100,000, typically they'll ask for three. Or what they'll do is they'll ask for 2 years and year to date P&L and balance sheet. So like we're August 20th right now. If you were to apply for, $150,000 loan for equipment, the bank will ask you for 2 years of financials, 25 and 24, business and personal. If there's K1 ownership of 25% plus on anything else in your 1040, they're going to ask for that too. because all of that matters as well as like how the cash flow is going and any other businesses that are being owned. And then year to date financials to make sure it's trending the right way, right? Because like you could have a killer 2024 of $2 million a year, and you have a killer 2025, 2.5 million, and then year to date, you're trending to do half. That's going to be a red flag to a bank. So that's why usually they also ask for year to date. Um, but these are just good things to know when you're helping someone get ready for any kind of financing like this. Okay, cool. So let's talk about the five C's of credit. These are the what lenders evaluate on every application. Many of you probably know this by heart. Some of you might know two or three of them. Again, we're going to play another game before I share it with you. Type in the chat for those of you oh, and I know Larry's on the line because he just wrote a book called The Banker's Edge. So he has to know this one. So Larry, I'll put you on the spot if you want to type in the chat. What are the five C's of credit? These are five words that start with the letter C that are the five elements that really score if a borrower is considered a strong borrower, or someone who's not ready, right? Approved or declined. The difference between approved and declined. Nick, you want to take a stab at maybe guessing a couple of the five C's?
I think it's a little unfair for me to guess because I might have already reviewed the slides.
Okay, 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 okay. All right, we'll keep you in the back end here, and you can fill in the blanks.
Yeah, yeah, I could
So
do that.
Larry's got three. Okay, and by the way, Larry, credit and character I are the same thing. Um, and I'll expand on that in a little bit. Okay. I think Christina's thinking about getting married or something because she's talking about diamonds. Color, cut, clarity, carat. I know there's like six C's to look for in like a diamond, right? Is that am I wrong there?
Or is it the
I
three
think
C's?
or it's four C's of diamond guide. Cut, color, clarity, carat. Okay, that's for a different webinar. I'm sorry, Christine. But hey, I love those C's as well. That's always cool. All right, so we'll jump into it. Won't keep you in suspense. So the first one was the one that Larry talked about, character. So character is credit history and track record of repayment. Like typically bankers are going to be like the analogy that I like to use is this one, okay? This is a really throwback reference. Back in the day when I was in middle school, we used to have lunch breaks. Did you ever have these lunch breaks, Nick? Like A lunch, B lunch, C lunch, those kind of things?
Yep.
Did you ever have one of those kids whoever like went by to other people and they're like, "Hey, can I get $1 so I can like buy my lunch?" Right? And if you say yes, you give them $1 and they don't pay you back. The next day they come back and you see them going to someone else and be like, "Hey, can I get $1?" And chances are you're like, "Huh, I haven't gotten paid by this kid. If this kid came back to me and asked me for $1 to pay for the lunch again, and I haven't gotten paid yet, chances are I'm not going to take that chance again." So I like to think of character credit history as that. Banks are going to look at your credit history and they're going to see, have you paid back everybody you've borrowed from in the past? Okay. Have you paid on time? Have you had experience at borrowing at this level in the past? Like, if I'm going to ask for $100,000 loan, and my largest credit line or credit borrowing request in my entire history is a $500 credit card. That's a huge gap of credit experience. So helping your clients making sure that they have experience in borrowing at those levels in the past. And that doesn't mean if like someone wants to get a $500,000 business loan and they've got a couple of $10,000 credit cards and they've had a house mortgage in the past and they have a couple of car loans in the past and they've paid it all on time and that's good enough to know, okay, this is a responsible borrower. They've borrowed large, responsible, big asset stuff, so it's comparable enough. So the credit history is important, and then also like similar types of borrowing at scale is an important factor. The character, have you paid on time, or are you like the kid in the lunch cafeteria constantly asking and asking and asking? And one of those elements is, did you go to 10 other banks asking for a loan before you went to mine? And that's the credit inquiry. So like not inquiring too much, because then that's also a red flag to say this is someone who maybe is like an impulsive person and you want someone who has discipline with how they use their finances. So being careful not to inquire too much. Now, I'm not saying you can only go apply at one bank, but I would limit it to three or less, right? Like if you're going to shop it around. And then there's another rule when you are shopping around for the same kind of thing, like a car or a home. If you all do it within 30 days, the inquiries don't count against your score. They'll show up as inquiries, but they won't negatively impact your FICO. Then the next one is capacity. Okay, capacity to pay is essentially looking at the debt service. So, like if I were to hypothetically lend you this money and your monthly payment would be this, I need to add this new monthly payment along with your current debt service, meaning like what's your mortgage payment, what's your car payment, what other debts do you have? There's like another factor that's pulled in. It's like your kind of your lifestyle expenses. The bank is a secret formula that throws that. And what they do is they grab that number and then they divide it by your income and they call it a debt to income ratio. On average, debt to income ratios that are considered acceptable can range as low as conservative as 35%. So if I made $10,000 a month in income, and if my total debt ends up being 3,500 or more, that could be too risky. But some banks can go as aggressive as 50% debt to income. So if I make $10,000 in income, or if I could prove that I make $10,000 a month in income, and my total payments, including this new loan request, is no more than $5,000 a month, then that would be a positive factor, right? Like that could be a qualifier. But if you've got someone that's at 78% debt to income, they're like up to they'll be up to here with debt, leaving very little disposable or living income to take care of their regular bills, right? Going out to eat and all those kind of things. So on average, 35% on the conservative end to 50%, depending on the loan type, depending if there's other factors that help the loan feel riskier or less, like your credit score, all these kind of things factor in your capacity to repay. The next is capital, right? So what happens is if you're borrowing and you've got no collateral whatsoever, remember, primary source of repayment is the income, is your cash flow, is your capacity to repay. Like your primary source of repayment is knowing that you have ongoing revenue that you're collecting, so that you use part of that to pay the loan. That's the primary. What's the secondary source of repayment? Well, typically, if it's not the money in your bank, right, like your savings, so like if your month gets disrupted or your business gets disrupted for a long period of time, you still got to make that payment. Your next thing you tap into is maybe your savings or your operating funds, like the rainy day money. So banks will also look at how much liquid assets do you have available. And if you have a very low amount of liquid assets and you're asking for a high amount of a loan, that could be a red flag too. It's like I'm asking for $100,000 unsecured line of credit, which means I have no collateral, right? My debt to income is 60% and I've got $100 in my checking account. That's all I can prove. Those are probably red flags for a bank. But if I'm sitting on, 50K of liquid money sitting in my account and my debt ratio is maybe 40% and I'm asking for 100K, the bank doesn't feel as that is as risky because they know that you could always tap into other sources of repayment if your primary source of repayment, which is your cash flow, gets interrupted. The other one is collateral. And we know this to be potentially a vehicle, equipment. In some cases, there are banks that could place a lien on your business entity, and this is called like a blanket lien. And essentially, this is like to stop you from borrowing elsewhere, like so that other business lenders know that you have an obligation with another bank, and that way you don't overexpose yourself. SBA tends to do this a lot where like if you have no collateral, guess what? Your business is the collateral. It doesn't mean that they're going to go after your business, but they're basically limiting your ability to expose yourself further. Okay. And then one thing to also think about is another ratio that banks look for is a loan to value ratio, LTV. Okay, so like if your car's worth $50,000, or the vehicle that you want to purchase, or the asset you want to purchase is worth $50,000, they might have a policy that says the maximum loan to value ratio could be 100%, could be 90%, could be 80%. We know this in mortgages, right? If you want to buy a first-time mortgage, a conventional mortgage, it's typically 80% loan to value. You have to put 20% down. But if you go with the FHA, you can go as little as 3.5% down payment, right? So all of these extra elements affect, the flexibility of how you can borrow. And then the last thing is conditions. Now, conditions are typically tied to the industry type and economic factors that affect the industry type. So I'll give you an example. Nick, you feel free to jam with me on this one. Go back to 2008 for a moment. What happened that was like a huge negative impact that affected everybody
The housing
financially?
market.
Housing market, right?
Yeah.
So if a real estate company came to the bank in 2009 and said, I want to apply for $100,000 unsecured line of credit, chances are the bank would have said, eh. They could have had all the liquidity, all the great credit, all the capacity, but because that industry was struggling so much, we needed to have a really, really solid case. All the other four C's have to be really solid for a bank to want to consider like lending to this higher risk industry in this particular time. And then again, there are other things, right? There's certain industries we know are red flags. Like banks don't typically like lend to the cannabis industry, like highly regulated. There's money services businesses, like check cashing stores. Like there's a lot of exposure for fraud. So like all these things do affect whether the business is considered high risk or low risk to lend to. So these are the lens you want to like help your client to see through before they enter into a bank. And your conversation with them around preparing for this and like what role you can play in helping them get their financials ready so they show enough income or think through strategically what they can do in the business. So when they go to their lender, they're ready to go. So I'll take a quick pause and a water break, Nick. Anything that stands out to you from as I reviewed this?
Yeah, yeah, no, I was actually just thinking to myself, I was going to ask you because you are the expert, but with collateral, would you say like it's very common that the stronger the collateral, the lower risk for the bank? So like the collateral of a home, you typically get better rates on a home loan
Yeah.
than a vehicle financing because your vehicle is going to depreciate. Would you say that's across the board? And then like if you have no collateral, those rates are higher?
That's exactly right. That's exactly
Yeah.
right. You go to a business term loan and they can range anywhere between like 13 to 20%. That's unsecured, no collateral. That's why you see some credit cards have like huge rates because it's also like there's no term to pay back. There's a minimum payment. There's high default rates on those. Um, when you look at a home or a commercial property, the rates tend to be really low because it's a real estate asset. And the other thing you got to think about is let's just say worst case scenario, you default on that, stop paying. What does the bank end up going? They end up repossessing these assets. Well, on average, whenever a bank goes to after they go and send someone to a collection process and they send the person to go repossess the car, then they all the resources that they spend, right, to recover the collateral, to then liquidate the collateral. On average, a lender typically recovers 10 cents on the dollar for every vehicle. So it's a huge gamble. It's a huge cost. It's almost like going unsecured because all the operating costs to have people send letters, to have someone repossess the car, to send it to the auction, to then sell it at a fraction of the price and recover that money and ends up being a tenth. And then when you look at real estate, it ends up being about 50 cents on the dollar. And there are properties out there that are, of course, foreclosed, et cetera. So it's not like banks are not in the business to repossess people's, like they want to be in the business of getting paid back. And so that's why these five C's really create a nice, solid foundation to minimize those. And on average, really good lenders, they know, right? They're gonna factor in that people will default because life happens and because sometimes, you take chances, right? Just like when you have your clients, there's a small chance that clients won't pay you. Clients will pay you not on time. Some of your clients might go under. We all take chances. And so what the bank is doing is building this to minimize that. And so they come out more. So it becomes like a good business that still works, that the majority of people do pay back and then they still are able to serve clients and give them what they need. So this is the one that decides a lot of the deals. We talked about it, capacity, repayment capacity. And I think again, this goes back to how could we advise and give clients guidance on saying, I know many of you who run a tax shop, many clients are like, make sure I don't get paid much, right? Give me a $20,000 a year income so that I don't have to pay too many taxes. Well, guess what? When a lender wants to lend to you and they see you only make 20K a year, it's going to be really hard for them to make a business case to lend you money. So sometimes what we used to tell clients, and we weren't tax advisors, but we could say is, look, if you want to borrow this amount, you have to be able to show that you can afford to pay it back, and that needs to showcase in the way you pay yourself and the way you show like the business is reporting, income. And I'll leave it at that because this is not about strategies to like how to finagle, finances or whatever, but it's strategically help your clients pay taxes that they need to pay so they can qualify for a loan. And look at one thing next to the other, right? Because some people are like, well, I want to get a loan, but I also don't want to pay taxes. It's like you can't get both. Unfortunately, you can't. Sometimes that requires us to have that difficult conversation. And really good, really seasoned bankers know how to have that conversation. And again, accountants and tax professionals and bookkeepers who step into the advisory role have the courage to have those conversations because they're doing a service to the client to say, look, bite the bullet so that you can get the loan because long term, we're thinking long term, you want to get from startup or growth to expansion or maturity. These are some of the sacrifices you got to make in order to transform from where you are to where you want to be. So yeah, it does require clients to be able to make some choices, which might mean they have to pay up front right now so they could get the bigger return long term.
Well,
And then yeah,
one thing I want to jump in on that point that I see, I don't know if anyone else does taxes in this group. I see every single year we have clients come to us in the summer and they're like, hey, Nick, I'm in a mess. I need your help. And they're typically, 3, 4 years behind on taxes. And then they want to get a mortgage and then some borrowing need comes up and then they need to get caught up and file 3 years of tax returns because they obviously can't get that loan with unfiled returns. So that definitely happens to us with a ton of clients every single year. And it's just something that's very important. I see Christine does that. Christine does taxes. So I'm sure maybe you've had a client or two who's been years behind. They think they could just ignore it until there's a need. And then we have to do, 3, 5, 10 years of tax returns.
yep. Or like what we want to try to avoid too is like I know some point in your career, if you haven't experienced this, Nick, or like those of you who are joining us here, is like the client's like, I'm at the bank and I need these documents. And you're like, we never talked about this. Like you're catching me off guard and like what documents and like, but it's not ready and you haven't given me your statements and it's like, and they're now pressuring you to get all this stuff ready. And you're like, you never even planned for it. And so like how can we be more proactive rather than fall into that trap where now the client thinks that you were the reason why they weren't able to get the loan, which is not the case, right? And so sometimes it's important to stay proactive and have those ongoing financial conversations with clients. Okay, so in the interest of time, I'll share a couple of quick slides here. We've talked about it already, so I won't go into too much, but these are some of the types of loans compared to like what purpose they want. Their equipment loans, business term, owner occupied, line of credit, business credit cards, SBA loans. SBA has three types of loans that you can help your clients learn more about. An SBA Express, only some lenders are like preferred lenders for that. And these are typically more for like those in the earlier stages of their business life cycle, seed, startup, growth. Your SBA 504 is a little bit more long term and it's for financing real estate and major equipment. And the 7A loan works without necessarily using collateral. I've done 7A acquisition loans. So, like if a doctor is retiring and another doctor wants to buy their book of business, like if any of you here are selling your practice and somebody wants to buy it from you, like they can actually obtain a 7A loan to be able to do the to be able to facilitate that financing, right? Rather than you having to finance it as a seller. Or if you've got clients again acquiring different books of business or a different business and absorbing it, a 7A loan is really great for working capital, for acquisition, and for just general growth. And they go up to 5 million. And so I'll give you 5 steps to take away before applying. Remember, if you are going to enter a conversation and helping your clients get ready for lending, is review their credit history, gather their financials, learn more deeper, like what they need it for, how much they need, understand all the options, and get them ready to at least not show up prepared, because then you don't want a banker to not put them in the right solution either. And a really good banking partner should be able to guide the business owners to make the right decision and get them ready. So we got the last polling question before we close this off. And then we'll share some resources with you and leave a few minutes for Q&A. So um, this question says, which part of getting loan ready do your clients struggle with the most? And the answers are financials, cash flow to cover the payment, which could be capacity, maybe their credit history. They've had trouble with credit in the past. Maybe the owner doesn't have enough like cash reserves, or like people don't even know what they need. Hopefully that's not the case. So we'll give it another minute. If you're in front of a place where you can answer the polling question, I know some of you are mobile, so you're not able to answer. That's okay. But if you're not, if you're in front of a computer, look at that pop-up, select the thing, so that we can go ahead and close the poll here.
Yeah.
Okay, Nick, anything stand out for you here?
Yeah, for me, I would definitely say it's having clean current financials because the amount of clients, it's typically new clients who will reach out to us and they'll say, "Hey, Nick, I need help with bookkeeping taxes with my business." And they're like, "Oh, by the way, can you get a P&L for me tomorrow?" And I'm like, "That's not possible in such a short period of time."
Yeah, for sure. And that goes back to being proactive rather than reactive, right? And this is the opportunity for us to add value beyond just giving them the reactive services. And so I'm not going to go into this detail, but there is a QR code. Actually, that one might not work, but let me give you this QR code so you can go ahead and access this resource quickly, and then I will finish off with a couple of resources for you. So, Nick, could you verify for me that this QR code does work, or someone in the chat,
Yeah, I'm
so
doing
you
it
all get
now.
a chance to pull this first? So I basically grabbed everything that we covered today and I put it into a nice little 4 or 5 page guide for you. So next time you look at enter, it looks like it works for me. It works for you?
Yeah, it worked.
So take a look at this. It covers everything that we covered today. Um, we'll share it in the recap email if you didn't get a chance to do that. But I'll give you these last 2 slides for you to take away when you think about positioning conversations with clients. The first is, if you're going to have proactive conversations to help anticipate needs, these are great questions that you can enter into. Is, what are your top goals for the business the next 12 to 18 months? You can change that to 6 to 12 months, whatever you feel makes sense, but help them think longer term. Any large purchases, key hires, or expansion moves you're weighing, and roughly by when? If a strong opportunity showed up in the next quarter, do you have the capital ready? Like, give them that if-then formula. Like, hey, if you land a big client and you need all these resources, how are you planning for that? What is your plan in case of a financial emergency or business interruption? What keeps you up at night about money in the business right now? What is one thing you would want financing already in place before you actually need it? Is there one for you, Nick, that stands out to you? You're like, yeah, I would like to ask this more, or I'm actually asking this more.
Yeah, I would say like I like getting, personal with my clients and like really understanding their goals and like what stresses them out. So I like number five, what keeps you up at night about money in your business. Just really know like what's stressing you out. Because I always like to like start at this client's pain point, and I think that's a good place, always like a really good place to start.
Love it. Yeah, everything works really well. Mine was always number one. And I usually say, hey, what major purchases or projects you got going on in the next 6 to 12 months? Everyone opens up when I say that. Like when I was in the bank, that was my first question I asked everybody who I introduced myself to. And it was like, oh, we're thinking about hiring more people. Oh, we're thinking about expanding. Oh, we're thinking about getting more equipment. Oh, we're actually thinking about, and then it just opened the conversation. Um, but I love it. Yeah, number five. And then many of you can, if you haven't asked one of these questions, my challenge to you is ask one. Ask one new question and see what comes out of it, right? And you never know. We'll leave these questions for you to also explore. You'll get access to this after the recording, which is, again, if they're about to step into a borrowing conversation with the bank, these are some really good questions you can enter with your clients. But with that, wanting to be respectful of the time, thank you everybody for hanging out. Nick, are you able to hang out 1 or 2 more minutes in case anyone has questions?
Yeah. If any questions come through, I'm good.
Very cool. So thank you, everybody. We'll hang out for another minute or two if anybody has questions, and please go ahead and share them in the chat. But I am curious for you, what is one insight that you took away that you'd like to implement from what you learned today? Share in the chat. What was yours, Nick?
Again, it kind of is this definitely like comes up like off the our second session. Just like I want to be more proactive with my clients and understanding what their needs are and how I could give them better guidance. And because again, like Deb was saying earlier in the chat, is like I don't want to wait until I see a big deposit coming into my client's account that they took a cash advance from their credit card because they need capital. So I want them to come to me with those questions because I want to be that trusted advisor. So this is just giving me more, ammo to, help my clients succeed.
That's fantastic. Thank you. Well, I don't see any questions, but I did see a great comment to kind of finish us off. So thank you, Christine, which is how to question clients when they say they need money, lead them through that process. So, absolutely. So thanks, everybody. This is the conclusion of our three part series of our credit education webinar. Nick, you've been awesome co-host. I really appreciate this. And be in touch with us if there's any other further questions of how Nick or myself can further support you on your journey to becoming a trusted business advisor. Nick, any final words for the good of the group?
Yeah, no, again, reach out if you have follow-up questions. Me and Carlos, I know we're both passionate about helping. So if there's any way we could help you, just reach out to us.
Thanks, everyone. Have a great rest of your afternoon.
Bye, everyone.